Hey guys, taking a look at Campbell's soup here. Um, I normally don't like anything with PEs over 16. I mean, to me, it takes you 16 years to get your money back, and then everything after that is profit. But if you're looking for a safe investment, a quote safe investment, because right now there's basically no safe investment. To me, in my opinion, you could say gold, but I really don't like to invest in gold right now because to me the average price of gold is $1,300, and if it's $2,200 right now, gold is overvalued. That's not to say it's not going to go up. I mean, you got China and you got Russia stockpiling gold, and at some point the U.S. might even lose its currency status as the world's currency. And China can say, well, ours is backed by gold. And Russia can say, well, ours is backed by gold too. The BRICS or whatever it's called. And we could go to war over something like that. And if we go to war, and if people are, we got mass layoffs, foreclosures. What are people going to be doing? They're going to be stockpiling food. And to me, this is a good, it's a good company. Granted, it might be a little overpriced right now, but yeah, if you would have bought it 20 years ago, or if you'd have bought it down here in '85, would have taken you a long time, but slow and steady wins the race. You're getting over a 3% dividend. They had just recently bought this Rayo pasta, and see that, but for 2.7 billion. I want to say they were making maybe 600 million or something. They plucked down 4.87 billion to buy pretzel leader Snyder's in 2018. Rayo, the parent company, went public in 2021 and will join a sauce portfolio that includes low-cost Prego, and Prego is what I use, and I love it. And Swanson broths. Sovos posted 1 billion in sales last year, up 25% year over year. Rio's brand hauled in 775 million in sales alone. That's sales, that's not profit. It says Campbell's share price has been down 19% for the past year. So yeah. Anyway, I think this is a good pickup. Is a good acquisition. Um, I like to read the conversations just to see what the mood is, and this one talk about one you love to hate. It said something like they were going to buy out flowers. Well, if they just bought this other acquisition, I don't think they're going to buy flowers. I guess I don't know if they're talking about 1-800-Flowers or something else. But this guy says dead money hasn't changed in 22 years. I like this guy where it says the go-to food in times of uncertainty, politics, World War III, Civil War, hoard away, brutes hoard away. I like this guy's post. So it sounds like they got a really good deal on this Rayo, and Rayo, I guess, is really good. I saw something they had like sales were up like 65% year over year or something. That's crazy. This guy says he had Campbell soup for over 20 years and have a small loss in it. I don't know how that's possible. Maybe he's not counting his dividends. This guy said, what I can't figure is why I do keep holding this stock. This guy says, start selling cover calls against your holdings. So, so that seems to be negative to me. I mean, 2016 it was 60 some dollars. Over here it was $58, and now it's 42. You know, it would have been nice to buy in the 20s or anything under 40. But, you know, if they're doing acquisitions, and I'm just looking at the wiki here, and it gives like a little history of, you know, what they have done. But I'm looking at the brands here, and these are the Campbell Soup brands. But then they also have Pepper Ridge Farm, where they make these things. They got Pace Foods, they got Swanson, they got Prego, they got Snyder's Lance. To me, these are like nabs, these Lance crackers. Let's see. So they just picked up this Rayo. Yeah, I love Prego. Oh, they got gold. They get those goldfish too. Swanson, Cape Cod, Lake July, Snyder's, Pepper Ridge. I mean, this is a pretty nice portfolio. Um, I don't know what all these things are, but um, I mean, they started out at Campbell's, and then they've acquired all these other things over the years. Chunky, chunky, chunky. Man, I love me some goldfish. I love me some nabs. They got Archway too. They got Tom's potato chips. I don't know. I think if the world goes to shit, which I think is going to happen, you know, people are going to be hungry. They're going to be stockpiling on this stuff. There's blood in the streets. There's shootings outside. There's war. They're going to be stockpiling food. And to me, canned food is what you're going to be stockpiling. But they just spent 2.7 billion on this Sorbos deal. You saw the last. I mean, the market cap is 12 billion. They spent let's just say 3 billion on this new Sorbos deal. And just reading this article here, right here, it said the 2-year growth rate is 67% for Sorbos. So that's really good news. The CEO says a match made in heaven. So it sounds like he really likes the deal. But what I was just going to say is, let's just say they paid $3 billion for this thing. I saw something where it said it's the largest acquisition since they spent 4.6 billion for something. Alright, so back here, like, they didn't even say how much they bought it for. But in 2015, they bought this brand for 230 million. They bought this one for 700 million. I saw something that they had bought something for 4.6 billion. Right here, the Snyder Lance for 4.87 billion in cash. Let me see. So, I mean, if you take 5 billion for that one acquisition, 3 billion for another one, that's 5, 6, 7, 8. The market cap is 12 or 13. To me, this thing, just looking at the face value on it, looks way undervalued. I mean, granted, the PE is not great, but if it was $60 back here in 2000, I mean, in 1998, $60, they thought it was $60 back then. You know, fast forward 20 some years, and it's $40. But to me, the reason why it's down is they instead of hoarding their cash or whatever, they're using their cash to pay dividends. They're using their cash to do share buybacks. And the reason I know that is I was looking at their financials, and ideally, you would like to see something going up, like Apple was. Everything's green and everything's good and everything's golden, but that doesn't happen. You got good years, you got bad years, you got ups, you got downs, but to me, everything looks pretty stable. They got positive earnings. They do issue a few more shares a year, but they buy back more than they issue. And I forgot what item it was under. This is the income statement. And I'm looking at the annual, not the quarterly. This is the balance sheet. You got their assets, you got their liabilities, you got their equity. So they got about $4 billion in equity. Their assets are more than their liabilities, so that's good. Net tangible assets. don't look at that. Don't look at the book value. They do have debt. All right, here's shares issued. Cash flow. But in 2020, they basically had $1 billion. I think this is $1 billion free cash flow. These are numbers are in thousands. So 2022, that's close to $1 billion. 2023 was down. That's still close to $1 billion. So let's say this company was worth $10 billion, and you were every year you're making $1 billion in free cash flow. I mean, to me, that's 10%. Here they repurchase capital stock. Issuance of capital stock. So to me, this repurchase of stock is bigger than the issuance of stock, if I'm reading that correctly. And this is quite a big jump. Look where they expect. Oh, these are the quarterly. These are the yearly. So, I mean, things are going up. They do have some inside ownership. But when I look at this, the bad news is the insiders, some of them have been selling. I mean, this is not a lot of shares, but 10,000. This is a little more. Sold. Is that the same guy? Sanzio Anthony. This is a different guy. He's sold. And then these two guys sold a really long time ago. $56. That's a lot of shares. So that is not a good sign when you see the insiders selling, because maybe they know something that we don't know. But I know something that they don't know. And what I believe is going to happen in the future is there's going to be wars. There's going to be rumors of wars. I mean, you got Iran, who is ballsy enough to fire some rockets on Israel. And you know for a fact that the U.S. will back Israel. A lot of you people probably don't even know, but out of the 13 tribes that was Israel, a lot of those tribes are here in the U.S. So it's basically like your brother or your sister getting bombed, and you think you're going to stand by and do nothing? But I go to SEC.gov. What I like is they're actually comparing themselves with the S&P 500. This is saying, hey, look, if you invested $100 in the Campbells in 2018, you know, here in 2023, you got $132. So it's not a huge gain, but it's not even a very long time frame. It's only 5 years. So in 5 years, your money would have grown 32%. That's really good. It's not as good as the S&P. It's lagging behind the S&P. But Total number of shares purchased. I mean, if you buy this thing, I'm not saying it's going to double anytime soon. Who knows? You might have to wait 20 years for it to double. But what I do know is that the number one rule of investing is to not lose your principal. So if the world goes to shit, yeah, this thing might go down with the rest of they might throw out the baby with the bathwater, but you're still going to be getting a 3% dividend. This company is still growing, although it's growing very slowly. But this is a chart that I like to see. I mean, if you were looking for something slow and steady to win the race, I mean, if you bought in 80 for $1 or $2, you're looking pretty. But it's probably not going to go to 80. It's probably going to go back to 60 at some point in the future. You're getting a 3.5% dividend, and you got some soup when things are bad outside. You can heat you up some chicken noodle soup and go to town. Get you a Nabs cracker. But, like I said, they had some better earnings in 2021. They went down a little bit in 22. They're coming back. They're not quite as high as they were in 2021. This company is not talked about on the news. The banks, what they do is they like to, hey, talk about this company or talk about that company. So at the very least, at the bottom, let's say, all right, you're buying the company for $12-13 billion. You got $4 billion in equity, at least, because the assets are 12 and the liabilities are 8. So 12 minus 8 is 4. So you got $4 billion in net assets right there. Then so now we got to find another $7 or $8 billion in assets, and to me, the other $7 or $8 billion in assets is purchasing these brands. This one alone, they paid $2.7 billion for. I forgot which one they paid almost $5 billion for. So to me, this thing is, I wouldn't say it's like crazy undervalued, but I would say that they're fairly valued. So they bought something, and but they also sell assets too. If they think that they're getting a good price, maybe, they will sell assets. All right, right here, they 2017 they bought Snyder's Lance for basically $5 billion in cash, which is the largest in company history. So that's $5 billion, and they just paid $3 billion, and that's not even including all the other acquisitions they've done. So just including the Lance Snyder and this latest one, what is it? Rayos. They paid $3 billion for this one. Let's say for Nabs they paid $5 billion. That's 5 plus 3. That's $8 billion for that. Plus everything else. I think this thing is undervalued. You could go through every little brand and that'd be like, all right, well, this one's worth, you slap a price tag on it and see, like this is the one that they paid $5 billion for. So I don't know how much they paid for Pepper Ridge. It probably says it somewhere. It says they acquired Danish multinational baker goods Kelsen that had an 85 country distribution network, which got them into China and Asian markets. They sold the Kelsen Group for $300 million. They sold that. All right, Sovo Brands, they paid $3 billion for. So I'm not sure which one is Sovo Brands. Does it say? Salvo Brands. I'm not sure, but they paid $5 for this one, $3 for this one. They paid $3 for Sovo Brands, which I don't even know what that includes, but yeah, I mean, if you got assets that are $12 billion, liabilities that are $8, You got 4 billion in equity right there. Plus they're buying all these assets, and these assets have not produced fruit yet. But these assets down the road, I mean, if they buying Rayo for 3 billion, they probably think it's worth 10. You know, or at least 7 or 8. So, I mean, I don't even really need to dive in more to this, because just looking at some of the basic math and looking at some of the basic acquisitions, so to me, if they got 4 billion in equity, that protects you on the downside. So, you know, so like, if you got 4 billion in equity, let's say this is 4 billion or something, you know, the price is probably never going to go below 15. But to me, you know, you're probably looking at a low somewhere probably like 30 maybe, and then but a high might be 60 or 100. I mean, if you see this, you know, some crazy numbers from Rayo, this acquisition, I mean, that could shoot this thing a lot higher. But if I had to guess right now, I would say the fair value would probably be at least 60, and probably probably 60 or 80. 60 to 80, I would say. But I'm not saying it's going to go there. I'm just saying, based on all the acquisitions and all these brands they own, and Buffett got in trouble because when he bought KFC, not KFC, the Kraft Heinz, he thought that the brand strength was superior, just like Gillette or you know, Coca-Cola or whatever. He was big on these brand strength. But what he didn't realize is that people really don't give a shit on ketchup, whether it's Hunt's, whether it's Heinz 57, whether it's, you know, like, just give me a damn ketchup pack to eat with my fries. You know, like, I don't care if it's generic. I don't care if it's, you know, whatever, as long as it's ketchup. So, if you were really serious about this company and like going all in or something like that, I would want to know what the captivity rate of these people are. Let's say, you know, if it's between Cape Cod and like one of their competitors, and Cape Cod is like goes up 50 cents. Are people going to still buy Cape Cod even though they went up 50 cents, or are they going to go to Lay's or something? You know, I mean, I don't know that. That would take some more research and digging in. But to find the real value of this company, you first would have to know what the value of their acquisitions are, and if they got a good price for that or not. I mean, like this Lance, let's say it was $5 billion. This Snyder Lance thing, I think that was $5 billion. This one was $3 billion. There was another one that they paid this Sovos brand. Cake and waffle. So I don't know if that. I don't think that's gone through. It says they were going to plan to buy them for $2.7 billion. So maybe instead of buying them, they bought the other one. But you know, if the equity is $4 billion, you know, what happened to the other 8? You know, like the other 8, I would say, or I would argue, is this is 5, this is 3, and then whatever all these other ones are, you know, this is extra value. So to me, this company is, without even having to dive into, I mean, this is a stable company. It is, you know, it's low growth, but it's growing. You know, net cash from 2021, 23 to 2021 to 2022 to 2023 is going up. Cash and cash equivalents is going up. I mean, I don't even need to look at this company really, because you know, I mean, yeah, they're going to have good years, they're going to have bad years, they're going to have ups, downs, but it's a stable company. And this, so it has these trademarks here. So this is saying the net tangible assets, that's $3 billion right there. But let's say all right, let's just say worst case scenario. You got assets minus liabilities at plus four billion. You got intangible. Let's say this is the low end, and this is, to me, this isn't all the trademarks. I mean, this is a lot more than what they're listing. But let's say this is 3. So 4 plus 3, that's 7 billion. You know, you're paying 12, 13 to get maybe $1 billion in free cash flow every year. to me that's a safe business. That's not, you're not going to be a millionaire overnight, but you're not going to lose. To me, you're not going to lose money, and I think, if this thing has an upside of 60 to 80 and a downside of 30, I would say that there's a good chance that in 10 years, you might double your money, and or maybe even 5 years, you might double your money, and you get a 3-4% dividend while you wait. Of course, it would be nice to know how much they pay on their dividend. I mean, this tells me how much they pay, but you would have to multiply how many shares outstanding by the number. So and this has the enterprise value at 17 billion or 18. This had it at 20 billion. So this is how many shares outstanding. There's basically 300 million shares, and if they're paying what, $2 a share, $1.50 a share. So out of their $1 billion, they're paying out like 450 million in dividends, and something like that. So if they only had profits of $773 million and they're paying out 450, that is a big chunk of their profits. Their profit margin is 8%. Return on equity, that's really good. Return on assets. They got $169 million cash and almost $5 billion in debt. The book value is $12. This cash number is a little concerning. You know, for a company that is $13 billion, you would maybe expect them to have a little more than $160 million. Because for one, there's 300 million shares. Right? So if every 300 million, let's say, well, there's 300 million people in America. There's more than that, but let's just say there's 300 million people in America, and every person in America owns one share of Campbell Soup, and every person gets $1. Well, that's $300 million, and their dividend is $1.50. So they would need $450 million just to pay the dividend. And right now they don't have it, according to this, but that's not to say by the time it gets around to when they need to pay the quarterly dividend again, you know, they would have the cash then. But it's a little concerning that a company is market cap of $13 billion and they only have $160 million. I mean, this company right here that I looked at the other day with a market cap of 80 million has 100 and almost as much cash as Campbell Soup does. Shit. I can't remember the damn symbol. So yeah, that to me that is a little concerning. I mean, granted, they just paid, you know, they just bought a company for $3 billion, so I guess it's, you know, okay that the cash is a little low right now, but to me, that's how companies get in a little trouble. You know, you just make a huge acquisition or whatever, and then things go bad and you don't have enough cash to survive the bad years. but yeah, all in all, I think I wouldn't say this thing is like going to 10x or 100x, 30x. I think this thing is probably around fair value, and it might be a little, like I said, the PE 16. That's not great. You take the inverse of that, 1 divided by 16. And multiply by 100, and you get 6%. So and out of that 6%, maybe 3% of it is just the dividend. So, or you could argue that it's 6% plus the dividend. But I think there's going to be a major food crisis in either this year or next year. And I think that this will be, I mean, you know what happened to Clorox back when the pandemic hit? Clorox went crazy. I hadn't even looked at Clorox lately, but this thing is pretty much dead in the water. They've left it for dead. No one really cares about it. Even the people who own it don't, aren't really excited about it. Like, this guy, he's food shortage and stuff, and everyone else that owns it owned it for 20 years, and I've taken a loss. So no one else really likes it. They left it for dead. And to me, when things like that happen, this is at least something I would watch. And let's say you wake up tomorrow and this thing's at $35. The 52-week range is 37 to 55, so it's going on the lower end of the range. And I think if you can pick it up at 40, I think it's worth at least 60 probably, and has the potential to double in the next 5 years. And that will get you through most of the recession, and if another pandemic or a World War III or something happens, instead of treasury bills, you're getting a 3% dividend, plus you got 20 to 40% upside, with maybe only 20% downside risk. Because I think 30's probably like if I had to guess, I would say 30 would probably be the low. Where it's never going to go below here, in my opinion, or it shouldn't for long. But yet you still have a $60 to $80 upside. So if it goes from 40, you buy at 40, it goes to 60. That's a 50% gain. If it goes from 40 to 80, that's 100%. Meanwhile, you do have a 25% downward risk. Who knows that this company they just spent all that money for, maybe they so they did close the Sovo deal. Oh, well, the servo deal was the Rio. Okay, all right, that makes sense. So they got V8, they got Goldfish Pepperidge Farm. So yeah, I like this company as a safe pick to basically not lose your money and to create a little bit of wealth while you wait. So let's say if they spent five for this one, and then three for this one. The crown jewel of the purchase is a fast-growing Rio brand. This mixed Noosa yogurt. So yeah, this is how a really old company like Campbell's Soup can they can't be a young company anymore, but by adding acquisitions they can still grow. I mean, they're not going to grow crazy. They're not going to grow like Google or Amazon or something, but slow and steady wins the race sometimes. And even though it doesn't look good with only 160 million cash right now, a company this old and this company's been around for what 150 years or more. 155 years this company's been around. And this lady owns 15% of the company, so you got some insider ownership. You got 20,000 people working for you. The net income in 2020 was 1.6 billion. But these are what the analysts are thinking. You know, the analysts, like I said, no one really cares about this company right now. They neutral to neutral, hold, neutral. Like, yeah, there's a couple buys, there's a couple sells, some underperform, sell, but most people are in the middle here. Actually, there's you got 17 strong buys, 10 holds, 4 underperforms. So there's more analysts that are recommending it than, so it's kind of either a buy or a hold. But I think if shit hits the fan and people need food, this is going to be something that they're going to be buying. I'm not going to say it's going to be like Clorox did in the pandemic. I don't think it's going to be that crazy, but like I said, I think in the next 2 to 5 years, I think this could easily go to 80, 60 to 80 range, which would give you a 50 to 100% return in the next 5 years. Now, I'm not going to say it's going to stay at 80. It might shoot up to 80 real quick and drop back down, but or 60. But I mean, hell, 20 years ago it was 60. You know, 8 years ago it was 60, and they just keep buying all these acquisitions and stuff. So to me, if it was 60 10 years ago or 20 years ago, it has to be worth more than 60 now. Anyway, you guys can make your own decision. This is not financial advice. This is just my opinion as an average Joe, know-nothing investor. Just taking a quick look at Campbell Soup, and this is one that I was seriously considering buying. Even though I don't like to buy things that are PEs this high, I'd rather buy something at 2 times earnings or 5 times earnings or 6 times earnings. But the reason the PEs are high because these are great businesses. These are great companies. So you're going to be paying a premium. But to me, this is not really a premium. This is more like a fair value. Like I said, if you can try to get it under 40, that would be ideal. And I think the price target for the next 5 years could easily be 60, and maybe even a spike to 80 with only a downside risk of maybe 30. And no matter what happens, good, bad, or ugly, you're still getting a decent dividend. And if inflation goes back down to 2%, I think we're going to have deflation eventually. You're going to stay ahead of inflation, and your purchasing power is going to go up, and you're not going to get poor every year like everybody else.